presentation contains current opinions of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that those opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation.
Hello everyone, and welcome to the Compact Market Wrap Weekly Update for August 24th, 2026. I'm Moe and Javaid, President of Compact Asset Management, joined by Javaid Ansari, Executive Vice President, Compact Asset Management. First of all, a housekeeping note, make sure you click on the subscribe button and the bell to make sure on the YouTube channel to make sure whenever we post an update, you'll be notified. You can also go to compact.com and subscribe there. If you need help with your portfolios, you can always send us an email at invest@compact.com or just give us a call the old-fashioned way, 800-388-9700. Looking at the numbers last week, Javaid, a little bit of a pullback.
Yeah, a little bit of a pullback. S&P down 1.39% last week, Dow down 0.78%, Russell down 1.6%, growth stocks took a little bit of a hit, down 2.3%. EFA held in there, which is nice to see. EFA only down 0.5%. Value stocks were only down 0.5% as well. So that rotation trade, Magnificent Seven has gone nowhere this year. It's really been driven by the other 493, which is actually nice to see. And emerging markets were up 1.24%, and NASDAQ down 2%. So I think we're just still, it seems like everything, I was looking at the earnings, right? Because once again, earnings, as you always say, is the mother's milk, right, of the stock market. And so, looking at the S&P up 12.95% for the year, fantastic. And actually, if you look at the forward PEs, or the value of the stock market's actually gotten cheaper. I know we're up 13%. People, a lot of the times, they just look at the price of the stock market. They go, oh, the stock market's expensive. Well, you got to look at the price relative to the earnings. The earnings have actually risen faster than the stock prices have. And so the valuations of at least the forward PEs, right, have come down over time. So that's a really good thing. Question is, are those earnings going to materialize in the future, et cetera? Bond market, everything is kind of still pointing in the direction that that probably is going to be the case. Margins are still very much pointed in that direction as well. So it's a very interesting dynamic, is where usually you see profit margins rising and earnings expectations going up after a recession or a bear market, is when things really recover, and then you kind of have these bullish expectations. It's kind of rare that we see them at all-time highs. And I think that is just the power potentially of AI and the productivity gains that it can lead to, both in terms of earnings, but also just overall GDP growth going forward.
But we haven't seen those productivity gains yet. It's all basically on expectations.
Yes.
What's going to happen, how everybody is going to use AI. And I still believe, as I've said for the last 3 years, AI is going to change the world, just like the internet did. And it could be a bigger change than the internet, which is obviously everything we touch and do every day now has to do something with the internet. So I think AI is going to do that, but where exactly it's going to show up, who is going to get paid, who is going to make money out of this, I think has yet to be decided. And that's going to be the key, to find those companies that are going to profit the most from AI. Right now, everybody's building out these AI centers, and everybody's betting on the chips and the chips that are going to be used in AI. The question is, how is AI going to be used, and who is going to be making the most money out of AI? That, I think, we'll find that out over a period of time. Right now, it's just AI data centers and chips that are driving the AI boom. Last week was a pullback in the markets, and I think the market looks a little tired overall. I'll talk about the data going back about 36 years in a midterm cycle, what happens when an election is coming up midterm since 1990. That's been the case. Seasonally, that's a weak time for the market. Market is fully priced. Technically, we're a little shaky. So a little bit of a pullback, a little bit of a reset, a little bit of a taking the froth, the pause that refreshes, as I call it. That could be the case. I mean, we've been on a sprint, but you can only run so far, so fast. And after that, you've got to slow down and catch your breath. And I think that's what might happen, could happen in the market. But that, I think, is going to be short-term a month or so, if that happens, and just go sideways to slightly lower. That's all what I'm looking for.
Well, and I think now technology is such a large part of the overall S&P 500 and the global economy. When you see technology down 3.2 for the year, still up 20% year to date, but down 3.2 last week, and other sectors more like healthcare, energy, materials, them leading the way. Not your runaway bull market type of industry. Energy's up a lot because of the situation with Iran, which seems to be just kind of in a stalemate. Healthcare has really been generated around, and I think I talked about it a little bit a while ago in terms of biotech. I think AI is really going to help accelerate and increase the probability of a lot of these clinical trials being successful. And that's what we saw, I think, last week with Moderna. They had a really good late trial success with I think a cancer drug. And so if biotech is one of those sectors that traditionally has been actually just as good as technology, and starting to see some nice gains there. So that's where you're starting to see some of the productivity gains and some of the really tangible effects of AI starting to show up in actual products. So
I was looking at the chart. I didn't put it out. I should have put it on the YouTube presentation. The AI is starting to break out after building a big base. Technically, it also looks good as far as
what do you mean by AI?
I mean biotech.
Biotech.
The biotech chart is starting to look very good and is starting to break out. I'll put it out next when we do the update on that. Oil prices still remaining elevated. They haven't spiked up like they did at the beginning of the war, but they've stabilized at a high level. That's really the key. But gasoline prices still at $4 a gallon, not out of control.
But I think that's going to creep up slowly, right?
Yep.
As crude oil prices remain at these elevated levels, and until we get above $4.50 on the national average for gasoline, that's when it starts to bite a little bit. And I think it could cause a growth slowdown if it gets to $5.
Yeah.
But it's not going to go there overnight. It's going to kind of slowly but surely, if there's no basically opening up of the Strait of Hormuz relatively soon, I think those prices are still going to tick higher. There's a lot of different things going on. I even heard about now, because global climate change, whatever you want to call it, if you believe it or not, but the ice is melting on the poles, and so now for the first time, Korea was sending a shipping container through the North Pole to get all the way to Europe, and that actually cuts the transportation costs by 11 days. So you think about the amount of fuel that's saved, insurance, and just time, that could really change a lot of things. So you're seeing, when one kind of door closes, something else sometimes opens up, hopefully, and that's what we're starting to see in terms of these different flows. So that's, I think we'll continue to monitor it. We'll, of course, been talking about our DBO chart, but until we get above that 4.5, I think we're okay.
We saw rates go up a little bit last week from 4.68 to 4.74 for the 10-year. Also, we saw high yield down, which was not good. But so was U.S. bonds.
So
Treasuries were down too.
So I think that was the big news last week, where it was the Treasury came out and said that they were going to basically increase the bond buying program a little bit. The actual nominal amount wasn't that big. I think it was going from $2 to $4 billion, which is kind of a rounding error. But I think what it does, it goes back to some previous monetary policy around Operation Twist, where the government's saying, hey, we're not going to let interest rates get too far out of control before we kind of come in. And I think it was more of a signal to the market that says, hey, we're looking at this. Don't get too crazy in terms of raising the interest rates in the short term because of potentially the situation in Iran, et cetera. And so it'll be interesting. But what we saw was interest rates went down on the news and they came right back up. So that's a little worrying for me because, as I've always said, you want, when the government comes in and does an intervention, you want the market to react in the way that the government is wanting them to react in terms of that intervention. When the government comes in and does an intervention and the market doesn't react,
that's not good.
That's not good. That's an indication that maybe the prices need to go further down, right, in case of maybe stock prices, or interest rates need to go further up. and the intervention wasn't potentially large enough. And clearly, the intervention wasn't a big intervention. It was just more of a signal. But it's something to kind of watch here as we go forward. Previous to this, you can see there is some worries there. They were also concerned about the yen, right? They came in and bought a bunch of yen because interest rates in the Japanese bond market had gone up a lot. So yeah, there is something kind of there, but I really feel as long as the growth and the earnings are still there, it's very manageable. And we're not going to see huge interest rate spikes. But
I think inflation is really the key. How are they going to control inflation? Warsh has come out. He's going to do a big speech on Friday
at Jackson Hole.
At Jackson Hole. This is the yearly meeting where all the central bankers get together. And what is he going to say about further intentions? Because he said he doesn't want to give any forward guidance on what they're going to do. But will there be any hints of what he's going to do with interest rates? And that's a big question. The question is, we've got a $40 trillion debt. We hit 40 trillion, which again is a lot of news headlines. It's a big number and all of that. But how do you control it? And inflation, do you just raise interest rates? Well, we don't want to do that because that'll hurt the economy, bring unemployment up and so on. And if you don't do that, what else do you do? I think one of the biggest things we have to see is government spending and government as M2. That's something that we need to look at. M2 is money supply.
Yep.
And a lot of people don't pay attention. Money supply, I think, is one of the best indicators of forward inflation.
Correct.
When money supply starts to go up, money printing starts to go up. That's what money supply is, amount of dollars being put into the economy. When that starts to go up, that's when inflation goes up. And if you raise interest rates and you're trying to control inflation, you also increase the amount of money you have to pay on the debt.
Yeah.
So it becomes sort of a catch-22 at some point, just doing that. So it's going to be a delicate balancing act that we'll have to look at and see what happens over the next few months or years.
Well, and I think that's one of the puzzles that we're really trying to discern when we're looking at these rising interest rates. Are they rising because of inflation? Are they rising because of the deficit? Maybe a slight, increase in just kind of people are just saying, hey, you guys are spending money like a drunken sailor, and specifically that's targeted to, Congress and the government, right? The administration. Even though I was looking at the numbers, you look at the administration, the current administration, the deficit would be below what it was during the Biden administration if it wasn't they've had to refund the tariffs. So they've refunded the tariffs. So the deficit's slightly higher, but not a lot. If you look at the interest on that debt, right, it's around 3% of GDP. It's similar to where we were back in the 80s and 90s. And we had much higher interest rates then. I'm sure you tell the stories all the time of getting your first home with a 14% mortgage. But I think ultimately it's going to actually come down to, and this is what worries me, Congress. And so, they're going to need to figure out how do we potentially get a little bit more revenue. And they're trying to do it through the tariffs, which I think is a horrible way to do it because you're actually bringing down growth and doing supply. But I think they have to find some ways of somewhat not tax increases, but some really maybe some tax increases. I think the only thing that I think ultimately puts us on a fiscally kind of more sustainable track is some sort of VAT tax, consumption tax, kind of what you have in Europe. That had not really been discussed, but I think that's really the only solution. When you look at our government spending, it's not that large. Most of it's going to basically two things, Social Security and Medicare. Medicare is kind of a universal right. Social Security is not a lot when you think about it, even though a lot of people, that's their entire retirement income. And so those are kind of direct transfers from the government to people. It's not like the government's spending it on themselves, right? That's going directly back to the people. There's, clearly in the medical profession, there can be a lot more productivity gains. And I think AI is going to do that, which is going to be great. So it's a really hard one to crack. And so, but I think ultimately, when I look at it, we're okay. And the reason is because it's a game of musical chairs.
Right.
And when you compare us to Europe, when you compare us to China, which are basically the other two major economic sources on the planet, they have their own fiat currency, right? That euro and the RMB. We're in a better place. We have more growth. Yes, the debt's slightly increasing at a better rate, but we're still kind of in a relatively, it's the best house in the neighborhood. The neighborhood's getting a little bit crummier with the amount of debt, but we're still the best house. And I think as long as we have that relative position globally, we're going to be okay.
This is an interesting chart. Usually we look at what the markets have done, the S&P. We're looking at the semiconductor index, the SOX index.
Which has been on a tear, up 66%
This year, it's up 66%, a huge run up this year. Those are the chips. But you can see the volatility. It was down 29% at one point this year. So it goes up and down like crazy. That's one thing we have to keep in mind, that this is a very, very volatile index. It goes up and down a lot. So we have to watch it, but it's gone up, 60, 70% at times, and this year is a huge run up.
Well, I think we just bring this as the weekly chart just because everyone's gotten you look at like DRAM, there's a new ETF that came out that really focuses on a lot of the chips, and of course the SOX index ETF is SOXX, but yeah, you can look at that intra-year drops is 30%. You compare that to the S&P intra-year drops of what you would expect, it's actually 14%. So if you're going to invest in semiconductor stocks, that's great. They've been up, they go up over a period of time, but you have to have 2 times the risk tolerance that you would for the stock market. So if the stock market makes you queasy, don't even think about the semiconductors because it's the ride. Yes, it can be when it's great. It's the greatest ride in town, but you have to be able to ride that bunking bronco, which is 2 times the volatility of the S&P. So you just got to know what you're getting into. When you look at AI build out, it seems like the problem is around supply, not demand.
Right.
So things are still very much probably in the camp of these things getting higher. But as they go higher, they can go down 30% like they did earlier this year, and then
and there could be years when you're down 50%.
Well, that's bear market years, but I think even just normal years. I think given the valuations and how much they've gone up, unless if you buy it today and it goes down 30%, you need to not bat an eye.
That's really what it is. Yeah. So if you get queasy with the S&P, you're going to get really sick with the SOX index. That's some people like the volatility.
And the way you ultimately construct a portfolio is you don't go 50% semiconductors. You just put a portion, right? And you control the position size.
Last week we did get data. Housing sales fell 12.4%. I think the biggest news this week is going to be Jackson Hole, what they do. And we do have other things coming out like personal income, durable goods. PCE comes out this week. It's not on there, but that comes out this week. That's the personal consumption index, that expenditures index that the Fed is the favorite tool for them to look at inflation with. So that comes out this week.
Yeah, I think, of course, Chairman Warsh's talk on Friday. One thing I've noticed is he's not giving any opinions on interest rates, and I think the talk's going to be pretty close, which is a little dicey. I think the market's saying, hey, if you're not going to tell what you're going to do, we're just going to push up interest rates, and then let's see what you're going to do. So we'll force your hand. The other big news, of course, we'll have Nvidia, Marvel, two big chip companies. They're announcing earnings this week, and basically the way it's gone with chip companies is the earnings are going to be great.
Right.
The question is they need to be really good. So if you beat your earnings by 10% or more, your stock goes up. If you beat your earnings by 10% or less, your stock basically goes sideways to down. If you miss your earnings, forget about it. You're down 20, 30%. So you have these expectations are very, very high. But because of the build out and once again that supply and demand for chips, they're still very much meeting the mark.
One thing I'm really looking at and thinking about is the circular financing. That's really getting me concerned. It reminds me of because let's say Nvidia gives $50 billion to a company and says, look, go out build a data center. But with that data center, you're going to buy $50 billion of our chips.
Yeah.
So what you're doing is giving money to somebody to buy your own stuff, and then you're saying, my sales are going up.
Yeah, but I think it's not as a little bit of this was happening back in the .com era.
2000. That's
2000. They had the same thing. It's kind of pay forward, and But the difference is that at least these companies, there's these. Back in 2000, the difference was, let's say, an Nvidia was saying, hey, we'll give you 50 billion, but we're going to borrow that 50. And we'll
We don't have 50
We don't have
billion,
50 billion.
but
The
they'll give it
difference
to you.
here is they actually have the cash flow. They're just reinvesting that cash flow at an extremely high rate. So yes, you're seeing some of that circular financing. The difference though between 2000 is that they actually do have the 50 billion. They're not borrowing it or just saying, trust us, we'll give you 50 billion. And then going forward from there. So a little bit different, but it has those same, history tends to rhyme.
That's the thing that worries me a little bit. But again, the profits are there, and these companies will continue to make money. .com companies didn't have any profits. They were not even making any money.
They were not making
It was only all
It was promised.
vaporware,
Yeah.
as it was called. It was something that will produce something in the future, and it's going to do all these wonderful things. Now it's real money, and that's what I said 10 years ago when I was looking at Microsoft, and it was sitting there at $30, $40, $50 a share, and everybody said, it's a dead company. I said, look at this company. It's making all kinds of money. Maybe the
still
stock,
is.
and they've been making money for the last 10 years, and they continue to make money, and their stock continues to go up. Same thing with Google and some of these other companies. They continue to make money. Looking at the technicals, this is the S&P 500, and I drew this red line right here just to show the RSI. It made a high right here, market made a high. It made a high right here, market did. This is lower. Market made another high right here.
Yep.
RSI is lower. So these are called divergences. When the technical indicators do not make a new high,
Yep.
and the market makes a new high, that is called a divergence. And that is something that you see in the short term could create some issues for the market. Today we closed below 76.58, which is the 20-day moving average. We closed at 52. So now next support is 7,500, which is about 100 points
That's
below.
nothing, yeah.
100, yeah, it's no.
So I think that I wouldn't, I think the 200 days, may be in play on this pullback. I was looking at it at 7,100, be about a 10% pullback, still nothing crazy. I mean, I was even looking back at this gap here from early April, right there, a little bit, right there, that gap right there, which is almost, that's a tangible break below, the 200-day, that would be a 15% correction.
Yeah,
You're
that's down to
basically
68, below 6,800.
6,800, right? But I think, yes, it's looking from the technical perspective. Fundamentals, everything still looks good. Technicals maybe starting to break down a little bit, need to recharge the batteries and kind of shake everyone up a little bit, and then you resume to the upside. But I'll be interested to see if we do get a pullback in the stock market, what happens with the bond market,
Right.
and what we're seeing there. And if the bond market remains rather subdued, then it's actually a buying opportunity, because a lot of people, I think they bailed out a little bit earlier this year with the situation in Iran. And when you look at smart
lot of
money,
cash sitting on the sidelines.
retail money,
Right.
the smart money, institutional money was kind of stayed in. They've gotten the returns, but some of retail money did kind of say, I don't know about this. This is a whole new kettle of fish.
And they're packing.
And they packed their bags, in February and March, and they haven't
right around
enjoyed
here,
the recovery.
6,500.
Yeah.
They got out.
So, but then you might get another bite at the apple. So we'll see.
I was looking at one data point in election years,
Yep.
in midterm elections, going
Yep.
back to 1990, going back 36 years.
Okay.
Market in August, middle of August through the middle of October has gone every time it's gone down, except one.
Middle of August, aka right now,
To the middle of
October. So the next 2 months,
It's gone down every time
you're
except
saying
once.
it's going down.
So I think that's the seasonal tendency.
Okay.
Okay, it doesn't mean it has to go down. Market doesn't have
I
to
can't
do
believe 1990 is 36 years ago.
It is
already.
36 years ago, okay?
Yeah.
That's what it is. It's a long time now. It
Yeah.
seems like it was just last year
Yeah.
for me, but
Yeah.
it's 36 years ago. So during those, we've had 18 elections,
Yeah.
and every time, 17 out of 18 years, it has gone down. And the average decline,
Okay.
now that's the quick,
Yeah.
it's 7%.
Okay.
So it's just a pullback.
It's a pullback. It's your seasonal
It's-
pullback. So it
it's-
seems like I'd be surprised if we don't test the 200-day at some point. If we were going to test the 200-day leading up into an election, the uncertainty, the situation with Iran also still happening. The market's kind of showing you some technical signals. It's still up 13%. So if you pull back 7, you're still up 5. You're still up for the year. And we go back to January. January is always one of our kind of indicators for the year. January was up, so I
Right.
still think it will be still an up year for the year. But I wouldn't be surprised if a little pullback. to
Little
the 200
pullback,
range.
but it's, as you said, I think it'll be a buying opportunity. You get a, and if you go down to 7,100, that's not even 10%.
Yeah.
So that gives you 7 or 8% pullback to test of the 200-day, and the 200-day is also going up, so it might be at 7,200 by the time you get down here, if it does go down. But today you broke the 20. Next support is going to be the 50-day moving average, something to watch. Weeklies are at fifth wave, again 74.67 is the 20-week moving average. Then the 50-week moving average is 7,050, which is coming up also. NASDAQ, just going sideways, but it did not make a new all-time high. That's the, S&P made a new high, Dow made a new high, NASDAQ did not. And a gap lower here, it's below now it's sitting very close to that 50-day. So the number becomes this number right here, which is 24,500, the dot plot. The famous dot plot, my dot plot. Now, Fed doesn't have a dot plot anymore.
Yeah.
They used to put
So
out
we
a
only
dot.
got one dot plot now.
So now we've got one dot plot. So 24.
But do you think we get if we hit that? But the market's already pulled back 10%. That maybe brings back those April lows into play.
Yeah, that,
Right.
on the NASDAQ.
On the
it would-
NASDAQ, like if you
Yeah.
pull back there, the market's got to be down 9-10%.
Yeah, from 27,000 to 24,000.
Yeah.
500 or so. That's the dot
So
plot right
so
there.
we'll see. I mean, yeah. Once again, you always got to when you start to see the corrections, you have to look at the composition of the correction. And
Yeah, but
if-
the NASDAQ can go down 10%. The S&P only goes down 5 or 6, 7. That's really what usually happens. Small caps also just pulling back, still at a high, but the 20-week moving average is right here, 142. We're at 146 today, so we're right here. That's a little bit of a pullback. Not bad if that happens. MSCI, that's for the international index, still a third wave, could get a fourth wave pullback here.
I think any sort of diversification. Once again, other equal weight S&P, international, small cap, all has been very additive to the portfolios this year.
Yeah, we're looking at, what else are we looking
This is
at right
oil.
here? Oil is
Yeah, once
sort
again,
of stuck.
it's above 21. 21 is kind of my danger zone for oil. So I think as long as we're above 21 on DBO, that's going to put upward pressure on gasoline prices. And so then, as this gasoline prices continue to tick up, it's just something we need to continue to watch. And so we talked about it, I think, at length last week in terms of what could basically happen with Iran. Who knows?
Who knows?
That it's.
I think it's now a stalemate and it's going to continue. We've declared an economic war. So I think we're not going to shoot at each other. Depends on how Iran gets squeezed. If Iran decides, okay, we are getting economically squeezed, let's start bombing again all the oil factories and all the oil refineries.
I haven't looked into this, but didn't we have all the economic sanctions on them already, and then we took them off?
No,
And
and
then
we did take them off for a week or two, but we've had these for 37 years.
Okay.
Now we've tightened them, supposedly. So now it's going to make them repent. I don't think so. I think the blockade could have an impact.
Of course.
When you're letting no ships come in, that could have an impact. So we'll see how it works, but I think it's just everybody's just going to have a lot of rhetoric now and talking, and we see, and there's oil flowing out of the Gulf Straits of Hormuz. That's the interesting part.
Okay.
Instead of the 20 million barrels that was coming out every day, there's still 5 or 7 million barrels now coming out of the new.
Okay.
So there's oil
So
coming
it
out.
is partially open.
It is partially open, so that's something to watch. Treasury interest rates made a new high, but sort of gone sideways now for the last since the beginning of
I
this
think
month.
one of the things we'll look at, maybe look at an RSI chart on treasuries maybe next week as
Yeah,
well.
that's what
because now we made a kind of new high, but let's see
If there was a
what's the strength of this high. I feel my personal feeling is deflation is still going to be a lion's share. We're seeing these episodes. We're kind of now normalizing in what interest rates have been for a long time, which is it was funny money there for a long time after the great financial crisis, negative interest rates, all these other things. That was just a very abnormal time for a long time. So it started to feel normal. But now I think 4% interest. Well, that's 2% GDP growth, 2% interest rate, and 2% inflation. You get your 4% 10-year rate. So anywhere around there, given 1 or 2% is fine.
Gold is starting to look interesting, isn't it? Broke
Yeah.
above the 200-day
It was the
moving
talk of
average.
the town, start the year.
Oh,
Right?
yeah.
Everyone.
I mean, it
but
was
then,
still-
I remember if you go back and we said, hey, now's a good time to sell some calls, buy some puts, do something like that. Make sure you're just not overexposed. That was, but now I think we maybe put in a little bit of a bottom there in June and July, and it's now looks like starting to wave count back to the upside. What we get above the 200-day last week.
Yeah, last week we did, and today we're down a little bit, but I still think we're up a little.
I'm
So
going to take a little bit closer look at gold here over the next
yeah, I
week.
think it's
Yeah.
something to watch.
I think it's
now.
just something also, once again, we've been talking about diversify. So you talk about not being over allocated to tech stocks. Now you can look at other stocks, a small cap, international. Gold is a diversifier. Bonds are a diversifier.
Problem is it does not give you any interest. It doesn't give you any earnings. All it is price going up. That's the only way you can.
Yeah, but it's a non-correlated asset, right? So it's not tied to necessarily interest rates per se, like bonds are, or the stock market. So it's just giving you a different return, and yeah, you want it to go up when maybe other things aren't going up, and so that's been the case here for the last month or so.
Here's the RSI, the yellow line right here.
Oh, so this is my favorite HYG AGG chart.
This is the HYG. This is the AGG.
So yeah, we saw a little blip last week, but we've come right back, and so
the
still,
RSI turned right back up.
so still looking
looking
as
good.
good as it's ever looked. So I think particularly if interest rates come down over the course of the next, let's say, couple of weeks, if we just see some of that, you're going to see AGG rally. So the chart could come down, but once again, if high yield is kind of remaining sideways to up, the relative start can come down. But my only kind of big concern is if AGG is going up and HYG is coming down.
That's what you don't want. Right?
That's what we don't want. And
Where
so,
this is going up and this is coming down.
exactly.
But
So-
if they're both going up together,
or they're both even coming, down
to-
together, it's
okay.
it's okay.
yeah, that's the way. So those are our thoughts. Those are observations for this week. Again, if you want, make sure you subscribe, click on the bell, so whenever we post an update, you'll be notified, or you go to compact.com and you can see the YouTube, you can see all the different things that we have at Compact, and you can get on our email list. So whenever we have events or we have, there was a wonderful event that we had last weekend, which we really enjoyed, where we had a book launch party for Feroz's book, my brother's book, Wisdom and Wealth, and I think it is really an interesting book to read. So make sure you get a copy of that.
You can also check out, just type in Wisdom and Wealth Solution. There's also a YouTube channel for that as well, so you
Right.
can see Feroz talk about the book.
Yeah, and there's some snippets and some talk about those, and
Yeah, he goes in quite detail on all the different subjects in the book, and so it's once again balancing not only having just a holistic approach to how you're viewing the world. Clearly, finance and wealth is important. We're focused on that every single day for our clients, but also now beginning to broaden that out. And I think it's just going to play a bigger role in terms of overall advice. It goes back to our mission statement here at Compact for our clients, which is to enhance your life experience, where financials play a huge part, and we're not mitigating that in any way. But if we're fortunate enough to be in a good place where the financials have worked out, financial plan looks good, now we can start to think about those additional things, those higher aspirational aspects of our lives, not only for us, but our children. And that's where Feroz really wrote the book for his two sons to pass on this knowledge. And we're looking forward to continuing to pass on that knowledge to not only our clients, but our Market Wrap listeners here throughout the rest of the year. So you'll see some new events around that, hopefully coming soon.
Yeah, make sure you go to wisdomandwealthsolutions.com. And it is there. If you need help with your portfolio, send us an email or give us a call at 800-388-9700. Those are our thoughts. Those are our observations for this week. We will be back with you next week. Until then,
Good trading.
This presentation contains the current views and opinions of Compact Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compact Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that over-focus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.